Wall Street titans are not immune to the economic tremors rattling the global financial landscape in the midst of the 2023 recession. Leading brokerage firm Charles Schwab was recently in the news for its extraordinary attempts to weather the storm. Let's look more closely at what Schwab's actions mean for the economy as a whole. Hello, and welcome back to Serious Coinage. In response to the recent economic downturn, the financial services firm Charles Schwab revealed plans to decrease operational expenses by eliminating positions and closing or consolidating several corporate offices. In a regulatory filing made on August 21st, Charles Schwab estimates that as a result of these cuts, the company will save at least $500 million annually on its run rate costs, but will also pay between $400 million and $500 million in charges related to expenses like employee compensation, benefits, and facility exit. This isn't just a short-term survival tactic. It's a direct result of the state of the economy as a whole. This decision is more than just a survival tactic. It reflects deeper economic concerns. The company's choice to seek additional financial sources demonstrates the severity of the current economic environment. The Westlake, Texas-based firm didn't say how many jobs would be lost, but it seemed to imply that layoffs were coming in the near future, and that most costs associated with them wouldn't be felt until the second half of 2023. Although Charles Schwab did not specify which office sites will be affected by closures or downsizing, it stated that it anticipated paying such real estate-related expenses in 2023 and 2024. In filing statement, the business highlighted previously stated incremental actions to streamline its operations in preparation for post-integration, as well as cost synergies connected to the consolidation of stockbroker TD Ameritrade, which Charles Schwab purchased for $22 billion in 2020. The job cuts and office closures come as the corporation evaluates its real estate footprint and tries to reduce operational costs. A Charles Schwab representative told the Associated Press, "We have said we intend to take a series of actions this year and into 2024 aimed at removing cost and complexity from the firm, including reducing our expense base and streamlining our operating model. As a result, some positions will be eliminated in the coming months, primarily in areas that do not directly interact with clients." After reporting $1.8 billion in net income in the same period in 2022, Charles Schwab recorded $1.3 billion in July. Charles Schwab revealed to Think Advisor and other media sources last month that the company was in fact closing offices in Atlanta, San Antonio, San Diego, St. Louis, and Tampa by October 1st, as well as reducing its real estate presence in 6 additional regions. Moreover, Schwab reported earlier this month that it is now seeing a temporary decline in net client fund flows. This decrease is due to the loss of assets from certain retail and advisory clients when the firm undergoes the integration of TD Ameritrade into its operations. Investors have been watching the company closely in recent months, especially since the March failure of several mid-sized U.S. lenders. The event has brought to light unrealized losses resulting from securities stored on bank balance sheets. Impact on Wall Street and its repercussions. The announcement by Schwab caused a drop in the stock price, a possible hint that investors were worried. Although the company expects annual savings of $500 million thanks to these actions, the market's initial reaction was negative. This drop in stock price after the news illustrates how shaky investor confidence is in the market at the moment. The greater economic picture. The problems extend far beyond Wall Street. Large-scale layoffs have been reported in the IT sector, which is normally immune to economic downturns. The increase in weekly unemployment claims to over 200,000 is very concerning. The enormous amount of over $1 trillion that Americans owe on their credit cards is further evidence of the financial hardship on families. Charles Schwab is also lowering the size of its San Francisco offices and laying off employees, the business disclosed in a recent filing with the U.S. Securities and Exchange Commission. According to the statement, Charles Schwab anticipates spending between $400 million and $500 million on costs associated with employee layoffs. As previously stated in July, Charles Schwab's intention is to implement a number of measures throughout this year and extend into 2024, with the objective of mitigating expenses and simplifying the organizational structure of the firm. This will involve reducing their overall expenditure and optimizing their operational framework. Charles Schwab spokesperson Peter Greenlee told SFGate that some employees would be removed in the coming months due to this, with no details given as to how many jobs would be lost. The 211 Main Street location is one of many in the United States where the corporation is cutting back on office space. The company's previous Main Street headquarters, among others, will remain operational while being significantly reduced in size. In 2019, Charles Schwab relocated the company's headquarters from San Francisco to the Dallas-Fort Worth area. The firm is reviewing its present office space needs and may eliminate or consolidate some locations. In addition, Charles Schwab stated in the SEC filing that the company intends to cut operating costs primarily through reduced staff and professional services. According to the filing, these cost savings are being implemented in anticipation of a full merger of Charles Schwab with TD Ameritrade. After acquiring TD Ameritrade earlier this year, the company has begun transitioning all of its accounts to Charles Schwab. Charles Schwab will be closing its town and country location due to the rise of remote working. As businesses throughout the country reevaluate their future real estate needs, Charles Schwab's town and country office will begin allowing its employees to work remotely. Charles Schwab is the latest company to rethink its real estate strategy. As remote work became more common, several companies across the country reduced the size of their offices or closed them entirely in an effort to save money and/or attract and retain staff. While some businesses can see the need for change now, others are waiting until their leases expire in the not-too-distant future. Financial services companies have traditionally had offices in Charles Schwab's Maryville Center location. The 215,000 square foot facility was completed in 2000 and operated as Scottrade's headquarters until TD Ameritrade purchased the company in 2017. When Charles Schwab bought TD Ameritrade in 2020, expansion plans called for adding space for around 200 more employees. The real estate needs of many local businesses are being reevaluated. Not only Charles Schwab's. Battery manufacturer Energizer Holdings is planning to downsize by half and relocate to Clayton, which is less than a mile to the west. Aside from SSM Health and Bayer, other companies that are consolidating their workplaces include footwear retailer Caleres, electrical equipment maker Emerson, bakery cafe chain Panera Bread Co., and Jack Dorsey's financial services firm Block Inc. The town and country location of Charles Schwab is undergoing changes as part of the company's overarching strategy. Smaller offices with modest levels of in-office attendance, less than 50% on busy days according to a company spokesperson, are being converted to remote work as the Westlake, Texas-based company reduces or relocates other offices across the country. The closing of Charles Schwab's offices may pose limited threat to CMBS transactions. The recent filing by Charles Schwab is the latest challenge to the office market, outlining plans to reduce its real estate footprint. But a new analysis from Barclays BCS suggests that the short-term damage may be largely mitigated due to the lack of termination options at the affected properties. Schwab did not specify which specific locations it would close, but a company letter from July mentioned plans to do so. It also noted plans to scale back operations in Boston, Chicago, San Francisco, Jersey City, and Henderson, Nevada. The Barclays report states that none of these three Schwab facilities in Chicago, San Francisco, or Jersey City had termination options for the debt secured by commercial mortgage-backed securities, CMBS. Moreover, the announcement of corporations like Charles Schwab drastically reducing office space will have a negative influence on investor demand for other office purchases. However, the impact on the affected CMBS properties will be minimal in the short term. The announcement by Charles Schwab is a reminder that the economic recovery is still fragile. The company's decision to cut costs is a sign that it is concerned about the future of the economy. It is also a sign that other companies may be forced to take similar measures in the coming months. Investors should be prepared for more volatility as the economy continues to recover. Thank you for watching the video. If you liked the video, please like and subscribe our channel for more content. We'll see you in the next video.